The message arrived at 6:32 on a Friday evening. It was from Daniel's best friend, and it contained only 4 words: "Don't check your account." Daniel ignored the warning and logged into his app. The $612,000 he had built over 15 years had effectively vanished. Daniel eventually learned that his account didn't drop because of a market cycle. He had handed his life savings directly to a thief. This story provides a specific case study in financial vulnerability, showing how investors can be led to confuse a digital interface with physical reality. 15 years earlier, Daniel was a disciplined engineer. He lived a modest life, skipping expensive vacations and keeping an old car to build a $250,000 nest egg through consistent saving. His university friend, Marcus, had taken a different path into high finance. Marcus wore expensive suits, drove luxury cars, and spoke about the markets with a level of certainty that Daniel admired. Daniel found the financial markets unpredictable and chaotic. By handing his money to Marcus, he found a way to stop worrying about the details, trusting that a professional would handle the complexity for him. At the point of transfer, Daniel focused on the potential for growth. He asked how much money he could make, but he never asked for a way to independently verify that his assets actually existed. Marcus promised Daniel exclusive access to a strategy that offered high returns with very low risk. To Daniel, it sounded like the perfect way to secure an early retirement. In finance, risk and reward are mechanically linked. High potential returns inherently require an investor to accept a high degree of potential loss. When an investment claims to remove the risk while maintaining the return, it breaks the mathematical logic of the system. A promise of extraordinary rewards with zero risk is not a secret strategy. It is a mathematical red flag that the numbers are being manipulated. For years, Daniel's account grew without a single setback. Even when the broader market was struggling, his statements showed his balance climbing steadily toward $400,000. This perfectly smooth upward line represents the returns Marcus reported. In reality, this is virtually impossible to achieve. Real markets are defined by volatility. They move in peaks and valleys, reacting to global events that no manager can avoid. Daniel's wife, Sarah, pointed out this inconsistency. She urged Daniel to find out where the money was actually held, but Daniel defended his friend, choosing to trust Marcus's reputation over the data. In a dynamic global economy, an unwavering upward curve is usually a sign of fabricated data rather than financial skill. The situation changed when Daniel requested a $50,000 withdrawal for a property. Marcus immediately became evasive, claiming there was a temporary liquidity issue with the investments. Marcus was running a Ponzi scheme. Money from new investors was used to pay earlier investors, completely bypassing the market. The crisis hit when new investors dried up. Without fresh capital, there was no money left for withdrawals. This stalling signaled the mathematical end of the scheme. With the influx of new victims stopped, the structure had no assets left to return. An investigator eventually confirmed the truth. The investments never existed. Marcus had spent the funds on luxury homes, expensive cars, and international travel. For Daniel, the impact was devastating. Every decision he had made for a decade, from his house renovation to his children's education, had been based on numbers that didn't exist. A digital balance on an app is meaningless unless it can be verified by an independent custodian who actually holds the assets. Rebuilding took Daniel over a decade. This time, he prioritized independent verification, diversified his holdings, and only used reputable, regulated institutions. Speaking at a seminar years later, Daniel explained to the crowd that his mistake wasn't simply choosing the wrong friend. He had completely offloaded the responsibility for his financial future to someone else. He told the audience that if an advisor is offended by a request for mathematical proof, that is the only reason you need to walk away. When it comes to your life savings, trust is a starting point, but independent verification is the only way to ensure your future is real.